Luca Paolini. August was a tough time for U.S. investors. You saw the VIX, or the so-called fear index, pop above 40. It's come back down to below 25. So is the worst over?
Probably. We don't expect the VIX to go back to the same level, but also we don't expect the VIX to go back to 10. We are in a new phase and more volatility, but we are not going to go back to the same level of volatility we saw in August, we think.
A lot of the problems over here were caused by tremors or problems in China, worries about their economy. Can China slowing drag down the U.S.?
I think so. If you have growth going to China down to 4 or 3%, it will trigger a global recession and the U.S. will be affected. We don't think this is going to happen. We expect China to grow maybe around 6, 6.5, and that should be actually enough to keep global growth at a decent level.
What about if the Fed hikes rates, whether it's this week or in December? What's the impact of a Fed rate hike on U.S. stocks? We'll talk about emerging markets in a second. Do you want to fight the Fed?
No, I don't want to fight the Fed. I think, first of all, that the Fed decision will not have a huge impact on markets. I think everybody expects the Fed to move. Maybe not this week, will be maybe in October or December. So the impact will be limited, but the US stocks are more vulnerable because they're more expensive than European, Japanese, and also emerging market stocks.
Well, historically, a rise in US rates really hurts emerging markets. Is that still the case? Are you avoiding emerging markets because of that now?
We're still cautious on emerging markets, especially on emerging market equities, but a lot of the damage has already been done. Almost every investor I speak to are kind of cautious on emerging markets. Everybody seems to be short. So I think the bad news are probably already reflecting in the markets.
And you're also a big fan of European stocks. Is this a valuation play? Because right now there's a lot of worries about what's going on in the continent, whether it be the migrants coming in from Syria or more trouble from Putin in Ukraine.
There are more factors. First is that there is some real growth in Europe. 1.5 may not look great, but it's much better than it has been in the last 5 years. We see a big injection of liquidity by the European central banks. Valuation is okay, but also we have lending growth. So a lot of factors supporting Europe, and let's not forget earnings. Earnings are picking up, and in Europe we are probably 2 or 3 years behind the US in the earnings cycle.
And let's bring it back here to the US. You are a fan of US high yield. That said, U.S. high yield sold off last winter because a lot of the energy companies, the energy issuers, they came down because oil prices collapsed. Oil is still pretty low, as well as the default rate, which is still pretty low. One of those has got to give.
Well, we think that the oil price is not going to fall much more from here. And to be honest, if you buy an average high yield bonds in the US, you get a yield of almost 7% with 2% default rate. So I think it's still a very good investment to make after the sell-off that we have seen in the last few months.
All right, finally, any other sectors you like here in the US?
We like tech because tech is cyclical and we expect global growth to improve. But also tech is not affected by the potential increase in yields because they have extremely good balance sheets. So I think it's a good sector with good fundamentals, good valuation. So we like tech.
Thank you, Luca. And thank you for watching The Street.